Oil prices hitting a 7-year high on Tuesday, trading in the mid-$80 range, actually above $85 and even higher. Joining us right now with his outlook on where prices are headed is Jeff Currie. He's global head of commodity research at Goldman Sachs. Hey, Jeff, early this morning, Richard Engel was on from NBC talking about just the heightened tensions right now between Russia, the United States, the Ukraine, and everything that's happening with NATO. This is a serious point of inflection. This is something that really matters right now. And maybe we don't talk about it enough, but it certainly looks like it's getting picked up on when it comes to the global markets, especially in the price of oil.
Well, when we look at the movement in the last couple of days, I want to emphasize that it's driven by fundamentals, not the geopolitical risks. Now, the market is much more vulnerable today to these geopolitical risks than ever before, at least in this cycle, because inventories are so low. So the very tight fundamentals makes the market more exposed to these events. But at this point right now, these geopolitical events really haven't led to any substantial disruptions in supplies of oil around the world. And I think it's important to emphasize that a lot of the risks that created that big pullback on Black Friday back in November of last year have all turned out not to have an impact on demand, whether it was Omicron, the SPR, or even OPEC. Bottom line, fundamentals continue to decline. Demand remains strong. The IEA flip-flopped on their weak demand forecast and put out a much more bullish outlook on demand right now, which underscores just how tight this market is. So I want to point out this market is fundamentally tight. Demand is above supply still. We don't have adequate supplies to cover this demand growth. That's what creates this upside risk. Our target by the second half of this year is over 100 at 105.
In terms of fixing the supply picture, could OPEC and Russia fix it somewhat if they wanted to, or do they like prices where they are?
You look at the world right now, there are only two producers who can produce more today than what they could in January of 2020 before COVID struck. And the answer to that is UAE and Saudi Arabia. Russia struggles to even hit their OPEC plus quotas right now, which underscores the lack of investment to grow supplies. The U.S. is nearly 1.8 million barrels per day below those January 2020 levels. So what it indicates is that OPEC, Russia, outside of a select few producers, do not have the capacity to be able to meet these higher demand levels, which is why inventories are likely to draw to critical operating levels during first quarter and create a lot of upside price risk. That's why our price targets, our forecasts are now well above 100 or at 105, which underscores the risk here.
105 for this quarter or for this year?
We're 96 for this year, 105 next year, and we expect it to breach 100, as you enter that July-August time period. But I want to emphasize the risk right now are very much skewed to the upside, given the fact that you don't have a lot of investors in this market, which means you could get financial flows moving into this market on top of relatively tight fundamentals. And that's an important point, is that investors for the most part have shunned this space. Look at the market cap. It's running somewhere around 5%, the energy sector, but overall the earnings are running around 5%, but the market cap is somewhere around 3%, which tells you investors' interest in this space is very weak.